To our spotlight for tonight, and that is, of course, the commodity prices, especially the oil, which has seen a bit of gyration. Crude prices continue to remain volatile. In fact, it sort of varied between gains and losses through the day, with WTI, NYMEX, and Brent crude dipped sharply in early trade after the Iranian oil minister, said that more oil will come into the market from the country once Western sanctions are lifted. However, a statement from Saudi Arabia said that they will do all they can to keep prices stable, and that lifted the sentiments. Now, we know that Goldman Sachs has been predicting the bottom for oil prices at $20 a barrel. To know if that is a sound call and to gauge the road ahead, I'm now delighted in fact, to be joined by Matthew Smith, Director of Commodity Research at Clipper Data. Thank you so much, Matt, for joining us here on CNBC TV 18. Well, let me first ask you, what do you make of the sort of, the kind of volatility that we have seen? Because, since June last year, oil prices have seen a significant decline. And an IMF paper that was issued recently said that lower oil prices largely is good for the global economy. How do you view this, Matt?
I believe that lower prices are good for those people that are large consumers and large importers of the commodity. And so the likes of India, the likes of China, the likes of the US are benefiting extremely from these lower oil prices in terms of the actual consumer. So the end user here is in the US is getting the huge benefit of lower gasoline prices. Here in the US at the moment, prices are down to just above $2 a gallon. That's the best we've seen, well, since the beginning of the year, but we've been averaging well a dollar below the levels we've seen in previous years on the national average each day. And so it's been 400 million back into the economy here that people can spend rather than put in their gas tanks. That said, it really is hurting those producers. And so the members of OPEC, the likes of Russia, and other large oil-producing countries are really feeling the impact of these low oil prices and hence lower revenues as well. So it's very much a mixed mottled picture across the world.
Right. Fair point, Matt. In fact, if we were to focus on the consumers, and in fact, you also mentioned that it sort of increases the disposable income and therefore they have money to spend on other things, especially because they're saving money on fuel prices. Now, since June last year, have you seen any significant change in consumer patterns? Like, for instance, in India, many would say that we are seeing some sort of a revival as far as the Indian automobile sector is concerned. Volumes are going up, and many are, in fact, attributing that to the dip in oil prices. So how is it like in the rest of the world? Have you seen any significant shift in consumer patterns because of the drop in oil prices?
Well, as you mentioned there, India has been a great example of that, where gasoline demand is up sort of 14% this year, extremely strong. Same with China as well. And so that's partly to do with their changing economy, how people are buying their first car, etc. And so gasoline demand's been exceptionally strong in China. Here in the US as well, we're up consistently, been about 3% higher than the prior year. And that has been a direct result because of these lower gasoline prices. But what you tend to see happen, and what we've seen here in the US, is that we haven't necessarily seen that translate into really, really strong retail sales per se, or really strong consumer spending. You're seeing people actually buying SUVs and buying gas guzzling cars. And so doing that as opposed to spending money elsewhere. And so that's the one downside of this. It seems kind of crazy that SUV sales will go charging higher because people are being relatively short-sighted and buying cars that consume more gasoline. So we haven't really seen the benefit of the full reflection through of this benefit in the lower gasoline price. When you break it down, it is a huge amount, because here in the US we consume sort of 10 million barrels a day of gasoline. That equates to nearly 400 million gallons. And so if it's $1 less for a gallon of gasoline, that's 400 million that should be going back into the economy as opposed to going into that gas tank. But we haven't fully seen that. And so that is relatively unfortunate, I believe.
Right. And perhaps one of the reasons, Matt, for not having seen it fully in terms of a shift in consumer patterns could be because consumers do not see these oil prices to remain at that level. They perhaps expect oil prices to see some sort of an uptick, and as a result of which many would perhaps, delay buying a car or an SUV. Do you think that's a fair assessment? Because they believe that in the long run, prices will increase. Therefore, it has not led to any significant shift in consumer pattern.
Yeah, I'd agree with that. I think that people still feel the scars of the Great Recession that we went through, sort of 2008, 2009. And so they've got this blueprint for what we could see again this time, where prices get down to the 30s and then rebound back up to triple digits again. And so that is the concern. So we have seen a relative change in behavior this time around, whereas with low gasoline prices, people are paying off debt per se, paying down their credit cards, etc., rather than being more willing to spend more. And so that definitely is the impact. In terms of the pricing issue, I think we probably are in a situation where we will have low prices going forward for a little while, but inevitably, whether it's sort of 2017, 2018, or 2019, we are going to return to a higher price environment.
Right. And perhaps one of the reasons could also be, as we've seen over the last couple of days, Matt, like on Sunday, we saw the Venezuela oil president sort of warning that if there wasn't, enough cooperation among OPEC countries, then oil prices could actually reach in the mid-20s. And then perhaps taking a cue on Monday, earlier today, we saw the Saudi, sort of cabinet assuring that they will be maintaining the stability in the oil market. So perhaps, is that an indication to you that now we may perhaps see more cooperation among the OPEC countries?
Yes and no. I think that the Saudi Arabia comments, not just in the last few hours, but also what we heard last week from Malay Al-Naimi, the oil minister there, is that they're looking for more cooperation among the members of OPEC. But inevitably, that may be in terms of oil projects. It may not be in terms of oil production. We've seen them be unable to reach any kind of cohesive message or that prior to all of this. Over the last few years. And so I think it's highly unlikely that there will be any change in tack from OPEC in terms of cutting production. It just doesn't make any sense. They know that they're going through this pain at the moment. They knew that they would feel the pain as well of these lower oil prices, but they've been through a year of it now. We are starting to see the impact on higher cost production, not only here in the US, but also in Canada, Norway, etc. And so their tack of trying to keep prices lower to push these higher cost producers out is starting to work. And so really they're in a situation where they have to hunker down and just try and outlast it, whether it takes another year or two. The problem arises in situations in countries really such as Venezuela and Nigeria, who are really financially crippled at the moment. And so as we heard from the Venezuelan oil minister saying that if we continue how we do now, we could get down to sort of $25. By all means, that is possible. And by all means, that would absolutely cripple them further than it already has done. And so it is very worrying for some of these OPEC members.
Right. Just a couple of last questions from my side, Matt. Of course, Goldman Sachs had predicted, $20 at one point, but it had also said that chances of that happening is less than 15%. But realistically, Goldman Sachs had said that by 2016, we'll see the prices at about $45 a barrel, similar to what World Bank had earlier said, that they see a slight recovery in oil prices. But you have other consulting firms like Renaissance Capital, which has said $60 a barrel by 2016. What does your own research say? How do you see the oil prices sort of gyrating? What's the range that you can share with us?
Sure, I think a range for the next year is going to be 40, 35 to the downside, and then 55 up to 60 on the upside. The reason I say that is that we're already basically at the lower end of that range now. The near term is when we're going to test the downside of that, simply because we are still oversupplied by about 2 million barrels a day. However, as we move through next year, we will start to see that demand-supply balance tightening up. And so by the end of next year, we should be higher than where we are now. But the thing is that every time the prices move up to, say, $55, $60, something like that, they will incentivize the shale production online here in the US. It is that much more nimble than traditional sources. Yes. And so we'll see that supply coming online, and that will therefore keep prices in check. To the downside, you tend to get this bargain hunting coming in as you get to that $35, $40 mark. And we're seeing that even just today as we've tested 40. People are jumping back into the market. And so I think it's a fair range between that sort of level.
One final question, Matt, before I let you go. At the end of the 90s, we saw, when the oil prices saw this precipitous collapse, it led to mega mergers in the oil industry. Of course, Mobil, ExxonMobil. You had, mergers like Chevron and Texaco, and many others. Do you see a similar consolidation happening right now? There are already reports, that companies are already sort of gearing up and sort of, creating a war chest for making these big acquisitions. Do you see another wave of consolidation happening now?
I do, but probably in the smaller companies, I believe. The ones that are really financially constrained now, and and the longer that we move on with the lower oil price and the more unhedged they are, and cash flow negative, we will see companies, distressed assets essentially being bought up by companies. In terms of a bigger acquisition, I don't necessarily think that's in the cards, but the longer that we're in a low price oil environment, you will see this sort of bargain hunting potentially taking place. And so, like we heard with Apache and Anadarko last week being looked at, but then at the same time, you're then having Anadarko being looked at by the likes of perhaps a Chevron or that. And so I think there is going to be a lot of talk in the market in the coming months about large-scale acquisitions, but ultimately it will take part in the part of those smaller companies.
Right. Right, Matthew, thank you so very much for joining us and taking your time out for being on The Big Picture tonight. Always a pleasure to speak with you. Thank you so much.